I don't think there are good arguments against my position. I think the people that oppose my position are idiots. And sometimes I call it crypto crappo, and sometimes I call it, well, crypto shit. It's just ridiculous that anybody would buy this stuff. And of course, I'm not proud of my country for allowing this crap, what I call the crypto shit. It's worthless, it's no good, it's crazy, it'll do nothing but harm, it's antisocial to allow it. But when you're dealing with something as awful as crypto shit, it's just unspeakable.
Remember, Charlie Munger told his 5 key tactics of how to invest a small sum of money. Charlie Munger reveals his 5 key strategies in 5 must-applied metrics for securing 50% annualized profits with a small sum of investment. Munger's wisdom is priceless for anyone seeking financial growth. It's essential viewing. While most claim you need capital to gain capital, Munger feels you don't require a vast sum to see remarkable gains. Here it is.
Warren and you are known for saying that if you work with a small sum of capital, namely I think being $10 million, Warren had probably said that he could guarantee that you compound that at 50% a year. So my question is, can you provide some examples? And I would kindly ask you to provide as many examples as possible and be as specific as possible. Thank you.
And then I hear somebody that really wants to get rich at a rapid rate with specifics. That is not what we try and do here. We want to leave some mystery so that you can amuse yourself finding your own way. You know, the good ideas that I have had in my life are quite few. But the lesson I can give you is a few is all you need, and don't be disappointed. And when you find the few, of course, you've got to act aggressively. That's the Munger system. And I learned that indirectly from a man I never met, which was my mother's maternal grandfather. He was a pioneer, and he came out to Iowa and fought in the Black Hawk Wars and so on. And eventually, after enormous hardship, well, he was the richest man in town, and he owned the bank and so on. And as he sat there in his old age, when my mother knew him, because she'd go to Algona, Iowa, where he lived and had the big house in the middle of the town, iron fence, capacious lawns, big barns. And what Grandpa Ingham used to tell her is there's just a few opportunities you get in a whole life. This guy took over Iowa when the black topsoil of Iowa was cheap. But he didn't get that many opportunities. It was just a few that enabled him to become prosperous. He bought a few farms. Every time there was a panic, and he leased them to thrifty Germans. He couldn't lose money leasing a farm to a German in Iowa. But he only did a few things. And I'm afraid you're not going to find a million wonderful ideas. These people, the computer algorithms do it, but they have a computer that's sifting the whole world. It's like placer mining. And of course, every niche they're in, if somebody else comes in, the niche starts leaching away. I don't think it's that honorable way to make a living, by the way. I would rather make my money in some other way than outsmarting the trading system, so I have a little computer algorithm that just leaches a little of everybody's trade. I always say that those people have all the social utility of a bunch of rats in a granary. It's not that great a way to make money. I would say that if you make your money that way, you should be very charitable with it, because you've got a lot to atone for. And so I don't think it's an ambition we should encourage. And the rest of us who aren't just leeching a little off the top because we're great at computer science. And that's what this room is full of.
Charlie Munger, the vice chairman of Berkshire Hathaway, has long been a beacon of wisdom in the investment world, with Berkshire Hathaway's market cap nearing a staggering $800 billion. It stands as the 9th largest global company by market cap and the top non-tech US-based entity. The sheer magnitude of Berkshire might seem like an investor's dream, But Munger and Warren Buffett, the company's chairman, have often expressed the opposite sentiment. They believe that the company's vastness hinders its potential for high investment returns. Why? Because with such a colossal capital, they are compelled to chase only the most significant investment opportunities, which are rarely mispriced. Or, in investment parlance, inefficient. This is where the first principle comes into play. The allure of inefficient markets, large-scale investors such as Buffett and Munger are often too engrossed in grand opportunities to notice the smaller, potentially more lucrative ones. This is where individual investors can find their niche. In the past, Munger and Buffett had to sift through countless financial reports to unearth a single viable investment idea. Today, thanks to the internet, identifying undervalued stocks has become considerably more straightforward. Using basic stock screeners, one can filter companies by market cap and PE ratio, targeting those that are overlooked by Wall Street. Due to their size, many professional investors, bound by regulations, cannot invest in companies with a market cap below a certain threshold, leaving a plethora of potential investments unexplored. Contrast this with a giant like Apple, which is scrutinized by 31 Wall Street analysts. Smaller companies often ignored present a golden opportunity for discerning investors to identify stocks trading below their true value. Before delving into the second principle, it's worth noting the immense value of learning from investment maestros like Munger. Their insights have transformed many an investment trajectory, and sharing their wisdom can only benefit the larger community. The second principle is simple yet profound. When the golden opportunity presents itself, seize it with both hands. Such opportunities are few and far between, so they must be capitalized upon. This can be the best illustrated with a baseball analogy. In a baseball, a batter's objective is to hit the ball to score runs. Ted Williams, one of the sports legends, emphasized the importance of patience. In his book, The Science of Hitting by Waiting for the Perfect Pitch, a batter can significantly increase his chances of scoring. This principle is mirrored in investing. Investors are bombarded with myriad investment options daily. However, only by patiently waiting for the perfect opportunity, one that is so perfect, one that aligns with their investment strategy, can they hope to achieve the success. Such opportunities are rare, sometimes taking years to materialize, but when they do, they must be pursued aggressively. This leads to Munger's third principle, the power of a concentrated portfolio. Traditionally, investment wisdom advocates for diversification, spreading investments across numerous stocks. Munger, however, champions a more focused approach, concentrating on the select few businesses that one understands deeply. He believes that this deep understanding can lead to a more informed decision and consequently higher returns. A testament to this belief is Munger's own portfolio, dominated by three primary investments: Berkshire Hathaway stock, Costco stock, and a fund managed by Li Lu. As Munger aptly put, it had he adhered to conventional financial theories, he would have been significantly less wealthy. The next strategy is very simple. We find wonderful companies and we buy them when they're on sale. That's it. That's all there is to it. We find a wonderful company and we buy them when they're on sale, and when they're overpriced, we go ahead and let them go and invest in the next wonderful company, and that's on sale. And the fifth tactics of determine if the company in fact on sale and wonderful here at Audacious Money Witch is by the use of these 5 metrics. All right, we've got a book value per share growth rate, earnings per share growth rate, sales per share growth rate, our cash flow per share growth rate, and then return on investment capital. If we've got all 5 of those metrics all giving us a good, then we have ourselves a wonderful company. And the book value per share growth rate, what we're doing is tracking the retained book value that the company has, or equity that the company has. And if they're able to grow that equity over time consistently for earnings per share, we're looking at net income and the earnings that a company produces, and we like to see again consistent earnings growing over time year after year for at least a 10-year period. Sales per share, we're looking to see the revenue that the company is generating each year. Is the revenue of sales, is the number maintaining or increasing? We don't want to see that number decreasing in any way. Cash flow per share, this is what the company has, the cash that the company has to do whatever they want to do with, and we want to take a look at an investor to make sure that company has enough cash to service any debt and be able to take care of future growth. Simply put return on invested capital in the return that management generates off the cash that they have, including any borrowed money. Any borrowed money, we like to see a return on invested capital consistent, something above 10% per year over year in a 10-year period. So free cash flow is the cash that a company has left over after they've taken all of their responsibilities. And as a money witch, we want to see that free cash flow, and we want to see a pile of cash to know that the company can service any debt that they might have that pops up, or handle any sort of vicissitude, as Charlie Munger would say, and still be able to continue growing beyond that vicissitude. So we love to see companies with positive cash flow, to see that cash growing year after year after year. As a money witch, debt is extremely important because it is extremely dangerous when it comes to investing in these wonderful companies. We do not mess around with debt. So if a company has more than 3 years worth of earnings in debt, we immediately take it off of our list, because we don't know if that company is going to be able to service their debt. Should some rough weather come their way for you guys and for me, where we want to be extremely risk adverse, we don't want to be involved with businesses that have this problem that could force them to get rid of us as owners of the business. So I would be very, very careful, no matter how good it looks, no matter how much money they are making, be very careful with stepping into that kind of an industry. In fact, any kind of that industry where there's a lot of debt, a lot of this information we're talking about comes straight from the company's 10K. And we love to view this information right there in the toolbox, where we've got the company's annual reports, their quarterly reports, their financial statements, everything aggregated together to help tell that story of, is this company wonderful? And what price do we want to pay for this wonderful company? So if you can learn on how to research these companies and use the metrics to identify how wonderful they are, then you'll be able to be your own money witch and invest the same way that we do in these wonderful companies. In conclusion, The investment world is vast and complex, but by adhering to these 5 principles, seeking inefficiency, seizing golden opportunities, and maintaining a concentrated portfolio, one can navigate it with the confidence and success. Subscribe to the Audacious Money Witch channel and hit the like button to learn more about other great investors such as Charlie Munger and Warren Buffett. You are such a good boy for watching my video right till the end. Bye.